Hello everyone, welcome to Money Minutes. This is Zak Gardezy. I am your host. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So here on Money Minutes, I'd like to share with you some of the latest market headlines and my outlook for what's ahead. So for this week's episode, we'll focus on the Federal Reserve's FOMC meeting, which concluded on December the 18th, where the Federal Reserve decided to cut interest rates by 25 basis points. I'll also share with you some of the comments made by the Federal Reserve Chairman and how the market reacted. So let's get right into it. Okay, so focusing on the economic data. Now, the Federal Reserve Chairman started off by talking about how the economy was actually heading in the right direction. GDP growth is 2.8%, which is annualized for the third quarter. Inflation is moderating, which means it's slowing down. Now, it did stall for the last couple of months, which is something we'll talk about, and that's not a good thing. But the labor market remains strong. It is showing signs of cooling down, which is actually pretty good in this environment because you don't want a very strong labor market, which is inflationary. Consumer spending is strong, but the real estate and housing market overall is quite weak. And so now, overall, taking this information in, the Federal Reserve was confident enough to still lower interest rates by 25 basis points. Now, of course, this doesn't directly lower, for example, mortgage rates, and actually the opposite effect is going to take place after what the Federal Reserve Chairman's comments were in this meeting. But nonetheless, the FOMC decided to lower the federal funds target rate by 25 basis points, and this will affect things like home equity loans, margin loans, credit cards, and anything that's basically a variable rate credit line, you'll see start to come down. But nonetheless, the overall economic backdrop was quite good. Now, moving on to the chairman's comments, this is where things got interesting. And so in addition to lowering interest rates, the FOMC, which is the Federal Open Market Committee of the Federal Reserve, also released the SEP, which is a summary of economic projections. They release this quarterly. And in the September release, it showed potentially 4 interest rate cuts for 2025. And in the December release, this has been revised down to 2 rate cuts. And also, inflation expectations are higher. And so this, of course, sparked some panic from journalists in the room and from the overall market. So there were lots of questions as to why. Now, the Fed chairman tried to explain this off by saying, look, inflation progress has stalled. Inflation isn't coming down as fast as they wanted it to. But really what was most shocking admission from the Fed chairman was that there were certain members of the FOMC who used the potential policy proposals of the incoming Trump administration and the effects of those proposals, such as tariffs and tax cuts, as justification for increasing their expectations around higher inflation and around the expectation of potentially less tax cuts because of this higher inflation expectations. And so this is concerning for a couple of reasons. Number one, the Federal Reserve is supposed to be a nonpartisan group. They're supposed to make decisions on the economy and the overall monetary policy based on the data that they receive and actual events that are taking place in the economy. So that's concerning. The other reason why this is concerning is because the actual outcomes and really, frankly, the policies of the incoming Trump administration are still not clear yet. For example, we have heard and know that there would be some tariffs put in place, but how much? Which countries will be hit with tariffs? Are they going to be able to negotiate their way out of tariffs like we recently saw with Justin Trudeau, the Prime Minister of Canada, who visited President-elect Trump and discussed the potential of tariffs against their country? And so this I could see happening with many world leaders who visit and talk about, what are some ways that they could get out of some of these tariffs. And so there's a lot still that's variable in terms of the incoming president's policies. And so to try and really adjust aggressively your economic projections based on this, I think is premature. Now, this is going to, as we saw, create significant volatility because the Federal Reserve drastically changed their expectations in the course of one quarter. And so what could happen? So I want to focus some time as well on talking about investments and how investors are thinking, and how the overall market reacted to the changes, number one, in the rate cuts, but also in changes to the SEP and some of the Fed's other comments. Like, for example, the Fed also talked about the neutral rate and being close to it. Now, the neutral rate is a theoretical concept where basically there is an interest rate out there. It's sort of like a moving target where once you get to this interest rate, the economy is neither being restricted, but it's also not being stimulated. Think of it like the Goldilocks interest rate, and this changes. And so the Fed chairman said we're probably close to this neutral rate. Again, going back to my points about the SEP and changes with interest rate expectations in terms of cuts, this is concerning because if we were supposed to get 4 cuts next year as of just a few months ago, and potentially maybe some cuts in 2026, but now the Fed chairman thinks we're close to the neutral rate, how many cuts are we going to get next year? And are we even going to get any cuts in 2026? And how does this affect valuations for things like stocks, bonds, and other investments? And so these are all big developments coming out of the Federal Reserve. And this is why the market has such a negative reaction to the Fed chairman's comments. We saw the S&P 500 have its second worst day of the year as the Fed chairman was speaking. And so now my overall outlook hasn't drastically changed too much for next year, but I just want investors to know how I'm thinking and how they should really start to think about stocks, bonds, and other investment classes. So in the stock market, of course, having less interest rate cuts from 4 down to 2 is not good for stocks. Stocks are valued. Of course, one of the aspects of it are borrowing costs, right? This affects companies. This affects liquidity. This affects the overall economy. And so when you have less interest rate cuts, this is a negative for the overall stock market. Now, when it comes to investing in stocks, in my view, for next year, this is what I've been discussing with Wealthstone clients, is that we want to be prudent, we want to be smart, we want to invest in the right areas. For example, with the incoming administration, you know the Trump administration is going to be very restrictive with international markets and be more accommodative with domestic markets. So these types of thought processes should shape your view in terms of how you invest in the stock market going into next year. Of course, with any investments, my advice is to discuss this with your financial advisor who can help you review your investment portfolio and make sure that you're invested in the right parts of the market. Now, in the bond and fixed income markets, having higher interest rates is actually a pretty good thing. At first, the Fed's comments caused interest rates in the market to go up. This hurt bond investments, but for bond investors in general, think of, for example, money market investors and bond investors, this means potentially higher interest rates for a little bit longer. This can be viewed as a good thing depending on how your portfolio is constructed. For those invested in private credit and floating rate debt, this is also a good thing because this means continued higher interest rates in these types of investments. And these investments have stayed rather strong as the economy has been quite strong. And in the private equity markets, lower interest rates means that we get closer to a resurgence in the private equity markets, more IPO activity, more deal making, more capital markets activities. So if we have less rate cuts, this could mean a bit of a slower rollout in the private equity markets. But again, as you shape your views in your investment portfolio, stick to your financial plan. If you don't have one, make one with your financial advisor or find a financial planner who will do that for you. But stick to it, be smart, be prudent. Don't take any unnecessary risks heading into next year. As we just saw, there is going to be a lot of volatility next year. New president, new policies, lots of changes. It's not the year, in my view, to be taking on excessive risk. And to close out this week's episode, I just want to point out that with these types of changes in SEP projections and this type of variability from the Federal Reserve, things can change. We could see in the next FOMC meeting or in the next release of the SEP that the Fed reverses course and goes, you know what? We've changed our views. We've got more updates in terms of the incoming president's policy proposals. And we actually think maybe we'll do 3 or 4 rate cuts in 2025. Or we could see later in the year, maybe the policy updates aren't going very well. Maybe the trade tariffs are leading to trade wars. Maybe the tax cuts are so aggressive and they're so inflationary that the Fed goes from maybe 2 cuts down to 1. And so there will be a lot of volatility. There will be a lot of changing data. So it's very important to pay very close attention to your portfolio. And again, just be mindful of the overall risk of your portfolio and take the time to meet with your financial advisor to figure out if you're taking on any undue risk. For Wealthstone clients, we decided, in the last couple of weeks, I decided to rebalance portfolios. So this means that you basically trim off the portfolio and take off some of the positions that you have in the winners, which have really done quite well. Positions like Nvidia and Tesla were reduced back down to their target allocations. So let's say you were somebody who was initially investing in a 60-40 portfolio, for example. Stock market does as well as it did this year. You're no longer in a 60-40. Your stocks have really increased in value, and you'll find yourself in a higher risk level than maybe you initially intended. So by rebalancing, you get back down to your initially intended risk levels. This played out well for us when the market had a bit of a pullback after the Fed's comments. And so these are some of those tactics and some of these different viewpoints that I have in terms of how to manage the portfolio in markets like this and based on events like we just had with the Federal Reserve. And so hopefully this week's episode helps you understand what happened this week with the Federal Reserve. And as always, if you have any questions, please don't hesitate to reach out. Thank you so much for tuning in, and I hope to see you all again next week.